Good morning, students. Let's start with a basic concept of financial management there, and that is working capital management. That is a wonderful concept to understand. We are starting a 10-minute segment today onwards so that you can understand these finance and accounting jargons, which are very complex in a very simple manner. That is what the aim of these 10 minutes jargon, you can say. Now working capital management, you can see the screen there and the concepts are written. Now what is basically working capital management? Working capital is nothing but the capital which is required for meeting the day-to-day requirements of the business, or you can say that the capital which is very much essential for running day-to-day activities of the business is called as working capital. Just for an example, let me give you some examples for you. Now when you are running any business, you need stock, you need inventory for a manufacturing business, and you need to maintain that stock. Now maintaining that stock is nothing but again working capital there. Let's say it is a restaurant business, let's say it is ice cream manufacturing, or it is steel manufacturing, four-wheeler manufacturing. You should have all these inventories with you. Inventory is nothing but stock, usually called as. So working capital is what, students? The capital which is required for running day-to-day activities of the business is called as working capital. Working capital is peculiarly compared with the blood in a human body, because without blood we cannot imagine a human body there. A person cannot go on without the blood in his or her body. Same way, a business cannot be run without working capital. So that is the tremendous importance of working capital. We can see on the screen there are two concepts. One is gross working capital, another is net working capital. As I told you already, working capital is nothing but the capital which is required for running day-to-day activities of the business, without which a business cannot function at all. Now there is another thing which need to be known by all of you, that working capital is very much responsible for maintaining liquidity in the business, students. Now you must be thinking, what is liquidity? Liquidity, it is nothing but the ability of the business to pay short-term liability. So liquidity is very important as far as any business is concerned. So working capital is very much required to maintain the liquidity in the business. And what is liquidity? Liquidity is nothing but ability of the business to pay short-term liability, and that is called as liquidity. So unless and until working capital is properly managed, liquidity cannot be maintained by the business. It means that the business is not solvent in short term. Solvent in short term means what? The business is not able to pay all its short term liability out of its short term assets. So let's come back on the concept of liquidity again. Liquidity is nothing but ability of the business to pay the short term liability out of short term assets, that is payment of current liability out of current assets, then that is called as liquidity. And do remember, unless and until a company is going to manage its working capital effectively, it is said that it is not short term solvent, or it is not managing the liquidity properly. That is what it is given. Now let's go for the concept gross working capital and net working capital. Gross working capital is nothing but, students, investment into current assets of a business. So what is gross working capital? It is investments in current assets of a business. Obviously we are looking from manufacturing point of view as far as these concepts are concerned. So what is working capital? Is nothing but investment into current assets of a business. So do remember, students, gross working capital is investment into current assets of a business, whereas net working capital is nothing but difference between current asset minus current liabilities. Now you must be thinking, students, that what are basically current assets and current liabilities. So let me explain you quickly what is CA and CL. Current assets are all those assets which are easily converted into cash within one accounting year. Current assets क्या होते हैं बेटा? Current assets are all the assets or short-term assets which are easily converted into cash within one accounting year. For example, cash in hand, cash at bank, debtors, bills receivable, stock or inventory. It comes in three forms, that is stock of raw material, stock of WIP, and stock of finished goods. If you want to understand this, then there is a simple thing. Let's say that you are making ice cream at home. Now when you are making ice cream at home, You know that first it is raw material in terms of milk, flavors, sugar. These things are ingredients as far as making the ice cream is concerned. Now you are going to merge them and you are going to freeze them for some time. Now when you are putting this particular content in a particular format into the freeze, now it is no more raw material. Now it becomes work in progress. Now after 2 hours or 3 hours, once the period is over, now it is finished goods in terms of ice cream. So inventory stocks comes into three format as part of current asset. That is stock of raw material, stock of WIP and stock of finished goods. तो आप आइसक्रीम बनाने जा रहे हैं तो उसके इंग्रेडिएंट रॉ मटेरियल है जैसे कि शुगर, मिल्क एंड डिफरेंट फ्लेवर्स. आपने उसको एक पर्टिकुलर मिक्स में मिक्स कर दिया और अभी रेफ्रिजरेटर में रख दिया आइसक्रीम बनाने के लिए. अभी आपका वो रॉ मटेरियल नहीं रहा स्टूडेंट्स, अभी बचा बना हुआ आपका वर्क इन प्रोग्रेस. नाउ जैसे ही 2-3 घंटे बाद आप इसको ओपन करेंगे डीप रेफ्रिजरेटर में रख के, ऑब्वियसली आइसक्रीम बन जाएगी. नाउ इट इज स्टॉक ऑफ finished goods. So I'm again repeating, current assets are nothing but all the short-term assets which are easily converted into cash within one accounting year are called as current assets. And examples are cash in hand, cash at bank, debtors, bills receivable, stock or inventory in all three formats. That is stock of raw material, stock of WIP and stock of finished goods. Along with that, even prepaid expenses and short-term investments can be considered as part and parcel of current assets. And what about current liabilities? Because we are going to see it as a difference between current assets and current liability. So current liabilities, students, are all those liabilities which are liable to be paid within one accounting year. So current assets are short-term assets which are easily converted into cash within one accounting year. Current liabilities are all short-term liabilities which are liable to be paid with the help of current assets within one accounting year. For example, creditors, bills payable, outstanding expenses like salaries, wages, interest, commission and whatnot, which need to be paid within one accounting year. So it is creditors, bills payable, outstanding expenses, proposed dividend, provision for tax, because income tax we need to pay or corporate tax we need to pay each and every year. So do remember students, current assets are all the short-term assets which are easily converted into cash within one accounting year. Examples: cash in hand, cash at bank, debtors, stock or inventory in all three formats, that is raw material, work in progress and finished goods, prepaid expenses and short-term investments or marketable securities, like when you have invested into gold, shares for a short period of time, you can sell them at any point of time and get the cash back. So that is part of current assets. Current liabilities are nothing but the liabilities which are liable to be converted, which are bound to be paid within one accounting year. It's not liable to be converted, rather current liabilities are bound to be paid within one accounting year with the help of existing current assets are called as current liability. Examples are creditors, bills payable, outstanding expenses, proposed dividend and provision for taxation, along with short-term loan which is taken for less than a year. So all these are nothing but the current liability. And do remember students, net working capital is nothing but difference between current assets and current liabilities. Now I'll just not touch permanent working capital and temporary working capital. We are rather going to focus on gross working capital and net working capital. So gross, I told you that gross working capital is nothing but only investment into current assets of a business. It is nothing but gross working capital. When we are talking about net working capital, students, net working capital is nothing but difference between current assets and current liabilities of a business. I just explained what is current assets and what is current liabilities. Now obviously one is always going to have a doubt in the mind that it is better to have a positive working capital. Absolutely, because CA will be more than CL. That is nothing but, you can say that, positive working capital. But what if it is negative working capital, my dear? So let me tell you that even having negative working capital is not at all bad. But for which industries? Where the industries are going to sell on cash and buy on credit. For example, grocery stores, retailers, restaurants. These are the industries which are selling on cash, but these are buying or purchasing on credit, and these are in the segment of having negative working capital. Now you may be saying that, sir, is it really good? Absolutely, it is not problematic at all when you are having negative working capital there. it is very good to have positive working capital, that is always to have more current assets and less current liability. But if you have negative working capital, then also it is not bad. For example, grocery stores, restaurants, these are the examples where you can say that negative working capital will also not at all bad. मैं आपके लिए कुछ बता देता हूं यहाँ पे that how negative working capital also can help an industry. Practically need to show you certain examples. So students, these are the companies with negative working capital which you can see on the screen here as of now. It is, you can see the screen. Okay, screen is not visible here. It is Hindustan Zinc, Tata Tele, Dish TV, HDFC AMC, Gujarat Gas, Tata Communication, Vedanta, ICICI Lombard, Adani Total Gas. These are some of the companies which are right now running with negative working capital and still believed to be very good. So students, do remember that company should have positive working capital on ideal side, but few companies can have negative working capital and still they can be at ease, rather they will be enjoying the financial position in terms of say retailers, restaurants, grocery stores and FMCG, fast moving consumer goods. So these are the industries can be found with negative working capital and doing very handsomely into the market. So this is the segment for 10 minutes students. I hope you enjoyed that. Working capital is nothing but the capital which is required to run the day-to-day activities of the business. There are two concepts. One is gross working capital, simply investment into current assets, and net working capital is nothing but difference between current assets and current liabilities. And this can be either positive or negative. Yes, ideally we can say that positive is good, but there are industries which are having negative working capital. More particularly, it is FMCG running fast moving consumer goods, along with that grocery stores, retailer shops, along with that even restaurants. These are the industries which are with negative working capital. And along with that, I explained you what is current assets and current liability. So stay tuned students for the next 10 minutes concept and have a wonderful day ahead. Thank you and God bless you.